48%. That's Figma's year-over-year revenue growth in Q2 2026, $370 million in a single quarter, against $249 million in the same period a year ago. For a company that went public on the NYSE as FIG, that number isn't just large, it's asterisk accelerating. 3 quarters in a row, 38%, then 40%, then 46%, now 48%. In most software markets, growth decelerates as a company scales. Figma is doing the opposite. So the real question isn't whether Figma had a good quarter. It's asterisk why the curve is bending upward, and whether the forces driving it are durable. Figma's public story begins in earnest with Q4 2025, reported February 18, 2026. Revenue hit $303.8 million, 40% growth year over year, and CEO Dylan Field called it the company's best quarter yet. The net dollar retention rate had climbed to 136%, meaning existing customers were spending 36% more than they had 12 months prior. That single metric told you something important. This wasn't just new logo growth, it was expansion inside accounts already using the platform. Then, Q1 2026 landed on May 14, 2026. Revenue accelerated again to $333.4 million, up 46% year over year, above Figma's own guidance range. CFO Praveer Melwani attributed the outperformance specifically to stronger than expected seat expansion across entire organizations, and to early adoption of 3 named AI products, Figma Make, MCP, and Figma Weave. Management didn't just report the quarter. They raised full-year revenue and non-GAAP operating income guidance, signaling confidence that the acceleration wasn't a one-quarter anomaly. By Q2 2026, revenue reached $370.1 million, 48.2% growth, pushing the trailing 12-month top line to approximately $1.1 billion. The growth curve has not flattened. It has steepened. Let's anchor the numbers. The quarterly revenue sequence from the research: Q2 2025, $249.6 million. Q3 2025, $274.2 million. Q4 2025, $303.8 million. Q1 2026, $333.4 million. Q2 2026, $370.1 million. That is 5 consecutive quarters of sequential acceleration in both dollar terms and growth rate, from roughly 38% year over year in Q3 2025 to 48.2% in Q2 2026. The EPS picture is messier. Q1 2026 EPS came in at negative 27 cents. Q2 2026 at negative 21 cents. Q4 2025 showed negative 44 cents. A wide loss driven in part by stock-based compensation and the costs of being a newly public company. Full year 2025 net income was negative $1.25 billion on revenue of $1.055 billion. The company is not yet profitable on a GAAP basis. What management has guided on is non-GAAP operating income, which strips out stock compensation and other items. And on that metric, guidance was raised after Q1. The earnings intelligence scores this print at 84 out of 100. Assessment factors cited: revenue growth acceleration of 48.2% year over year, and the momentum characterization of the trend as accelerating, not peaking. The causal chain here has a clear structure. Figma's core product is a browser-based collaborative design platform. Teams inside organizations use it to build UI, prototype products, and manage design systems. Because it is browser-native and seat-based, every new designer, product manager, or engineer added to a workspace is a new revenue event. The 136% net dollar retention rate from Q4 2025 suggests that organizations are not just renewing, they are adding seats broadly across functions. On top of this seat expansion dynamic, 3 AI products entered the monetization layer: Figma Make, which generates UI from prompts; Figma Weave, focused on design system intelligence; and an MCP integration that connects Figma's design graph to external AI agents. These are not speculative roadmap items. Management explicitly credited them for Q1's outperformance and raised guidance citing promising early AI monetization traction. The mechanism is: broader organizational adoption drives seat volume, AI products add a consumption or premium tier on top of that base, and together they produce the revenue acceleration visible in the data. The bear case from the research is specific and worth taking seriously. First, profitability remains negative on a GAAP basis. Net income of negative $1.25 billion in fiscal 2025 against just over $1 billion in revenue. The EPS figures across recent quarters are all negative, and detailed forward-looking statements on earnings per share have not been provided in guidance disclosures, which the research flags as a potential area of uncertainty. Second, the 10-Q filed August 5, 2026 disclosed insider activity: 12.5 million shares of Class A common stock sold in aggregate. Insider selling at this scale, proximate to a strong earnings print, is a data point worth monitoring. It doesn't dictate direction, but it does appear in the filings. Third, the software application industry score in the research sits at just 37 out of 100, characterized as early recovery with a cautious outlook and a risk score of 75. Figma is outperforming its industry on relative strength, up 9.3% versus the software application benchmark over 20 days. But if the broader category comes under pressure, even strong fundamental stories feel it in multiples. Fourth, AI product adoption could slow. The current acceleration assumes that Figma Make, MCP, and Figma Weave continue converting users into paying tiers. If adoption plateaus before meaningful revenue contribution, the growth rate risks reverting toward the company's pre-AI trajectory. The research in this film came from AlphaOS. The earnings intelligence layer surfaced the sequential revenue acceleration across 5 quarters: Q3 2025 through Q2 2026, flagged the guidance raise after Q1, and scored the most recent quarter at 84 out of 100. The Filing Signals module identified the 12.5 million share insider disposition from the August 5 10Q. The technical intelligence layer flagged that Figma is outperforming the cloud computing benchmark by 6.6% and the software application group by 9.3% over the trailing 20 days, while noting that momentum has weakened since the earnings print. The dependency graph traced the AI product relationships Figma Make, MCP, Weave back to management commentary across multiple quarters. One intelligence layer, one ticker, structured signal. Figma sits inside 2 industry classifications in the research: software, application, and cloud software. The broader industry score is cautious, 37 out of 100, early recovery cycle, which means Figma is a relative strength story inside a sector that is not uniformly healthy. It is held in ETFs, including WCLD, the Wisdom Tree Cloud Computing Fund, at a 1.18% weight, which connects its price action to cloud software flows broadly. The competitive context matters. Design software is not a crowded category at the enterprise level. Figma's browser-native, multiplayer architecture gave it a structural moat against legacy desktop tools. But the AI layer opens new vectors. If AI-native design tools emerge, products that generate interfaces entirely from prompts without requiring a traditional design workflow, Figma's seat expansion model faces a different kind of disruption than it has historically navigated. The MCP integration, which connects Figma's graph to external AI agents, is partly a hedge against this risk. It positions Figma as infrastructure for AI-generated design rather than a target of it. The executive change 8K filed June 4, 2026 is also worth noting. A leadership change at a company that has just re-accelerated growth and raised guidance is a variable that deserves monitoring. The research flagged it as a material event, though the specifics of the role were not fully extracted. The Goldman Sachs relationship also appears in the dependency graph, consistent with the company's recent IPO and ongoing capital markets activity. At a market cap of approximately $9.1 billion against roughly $1.1 billion in trailing revenue, Figma trades at a revenue multiple that prices in continued acceleration, which means execution on AI monetization is not optional for the valuation too. Research note. 3 things to watch as this story develops. First, AI revenue contribution. Figma raised guidance, explicitly citing promising early traction on AI monetization from Make, MCP, and Weave. The watch item is whether any future quarter disclosure breaks out AI-specific revenue or provides a more granular adoption metric. That number, when it arrives, will either validate or complicate the current growth narrative. Second, non-GAAP operating income trajectory. GAAP profitability is negative and significantly so. Management guided non-GAAP operating income higher after Q1. Whether that non-GAAP leverage expands alongside revenue acceleration, or whether AI product investment absorbs the margin gains, is the path from growth story to earnings story. Third, insider selling cadence. The 10-Q filed August 5 disclosed 12.5 million Class A shares sold in aggregate. As a recently public company with significant equity compensation, some insider selling is expected. The watch item is whether the pace accelerates or whether it stabilizes as lockup-related distributions normalize. Volume and price together tell that story quarter by quarter. The research behind this film lives at alphaos.finance/stocks/FID. Earnings intelligence, filing signals, technical overlays, and the dependency graph, all in one place. Research and analysis only, not investment advice.